Today the market sent a signal that most retail traders missed, but big money paid very close attention to it. When institutional investors move billions within a short window, it's rarely random, and today's activity hints that we may be entering a new phase of market positioning. Whether you are a long-term investor or a short-term trader, what happened today will matter for the rest of the week. Before we break it down, make sure you stay with me until the end, because the final part of this video explains the one indicator that quietly flipped this morning and could predict the market's next big swing. Early in the trading session, futures were calm, almost too calm, considering the amount of uncertainty floating around the economy. But beneath that calm was a different story. Several large institutional flows hit the tape within minutes of each other. These weren't small adjustments. These were multi-million-dollar repositioning blocks across tech, financials, and even defensive sectors like healthcare. When that kind of broad activity happens at the same time, it usually means one of two things. Either big firms know something the public doesn't know yet, or they are preparing for a shift in volatility. What made this even more interesting was the behavior of tech stocks today. For weeks, tech has been leading the market higher, especially with the excitement around artificial intelligence and cloud infrastructure. But today, something unusual happened. Instead of steady buying, we saw a wave of mixed positioning. Some firms increased exposure to large-cap tech, while others reduced risk in the exact same names. This tug-of-war normally shows up before major economic announcements, and that's exactly what is happening now with the upcoming comments from Federal Reserve officials. Whenever the market expects clarity from the Fed, volatility tends to tighten and then burst once the announcement hits. Today's institutional flow suggests that big money does not want to be caught off guard. They are hedging both sides. They are preparing for a scenario where the market could move sharply in either direction. That kind of preparation usually means traders believe the next few days will bring information that forces portfolio adjustments. Meanwhile, the bond market also sent a warning sign. Yields briefly spiked before pulling back, a behavior that typically indicates uncertainty, not confidence. When yields move like this, it's often a signal that traders are trying to guess whether the Fed will stay firm on policy or hint at a change. Every small shift in yields today reflected how sensitive the market has become to the possibility of updated economic guidance. Another detail that stood out today was the sudden rise in options volume. Not just any volume, but large contract orders targeting expiration dates within the next 2 weeks. This is the kind of activity that usually appears when hedge funds expect a short burst of movement. The fact that this volume expanded across both calls and puts suggests that traders believe the next move will be big, even if the direction is still unclear. If you look at consumer stocks, they also felt pressure today. This is important, because consumer strength has been one of the pillars holding up the broader economy. Any weakness there can trigger concerns about slowing spending, and when spending slows, earnings slow. And when earnings slow, stocks react quickly. The shift in consumer sector flows today may be an early hint that analysts expect softer numbers ahead. Now, here's where everything connects. If tech is mixed, if consumer stocks weaken, if yields become unstable, and if options volume surges at the same time, it usually leads to one outcome: a market preparing for a significant reaction. It doesn't guarantee a crash, it doesn't guarantee a rally, but it does guarantee movement. And big movement is exactly what institutional investors positioned for. So why did all of this happen today? What triggered this sudden repositioning? The answer lies in the economic calendar. Several key data points are scheduled to be released, including inflation numbers and employment updates. Both of these have a direct impact on how the Federal Reserve views the path forward. If inflation cools faster than expected, the market could surge. If it remains sticky, the market could pull back sharply. And this brings us to the indicator I mentioned earlier, the one that flipped quietly but sends one of the clearest signals. The volatility index, commonly known as the VIX, made a subtle move that almost always appears before the market shifts direction. It didn't spike dramatically, but it rose just enough to show that traders are beginning to price in uncertainty. This kind of early rise has historically preceded strong market moves within days. Right now, we are in a moment where the market is calm on the surface but restless underneath. Big investors are preparing, options volume is climbing, yields are unstable, and key economic data is around the corner. All of this suggests that the next move won't be small. The market is setting up for a reaction, and your job as a trader or investor is to stay informed and avoid getting caught off guard. If you want daily updates like this, make sure you subscribe and turn on notifications so you never miss a critical shift in the market. And if you found this breakdown helpful, stay tuned, because the next video will cover the exact sectors benefiting the most from the current repositioning.